low probability condition. And yes, even in low probability conditions, I can see those things panning out just as well as you can too. But the probabilities are not going to be in your favor as if you were looking at a low resistance liquidity run. You see how it took forever to get down there? See how it was a lot of give and take, a lot of back and forth price action, even though we could see the sell side it was going to reach for, even though we could see that fair value gap just below equilibrium. Just because we can see that, and just because you may have the patience to hold through that, I don't want you to focus there. That's not the trade setups I'm trying to teach you. I'm trying to teach you how to find the really fast and loose market where it just quickly, efficiently goes to your target. It allows you to be in the market very little in terms of time. And it delivers exactly what you're looking for quickly, expediently, and near painlessly. Now, I got to be careful saying things like that because it sounds like zero risk. And that's not what I'm saying at all. It just means that when we're trading with the insights that I'm trying to teach you, you're going to be looking for setups that are absolutely one-sided. And this morning, hopefully, I was successful in terms of explaining how it could have done both directions until it made that higher high and falling short of the consequent encroachment of that new week opening gap. Just fell short of it at 4087.75. And at that moment, I took you through all the indices, the NASDAQ, the Dow, and the ES. And we had the SMT divergence. We were inside that 10 o'clock hour. We were looking for it to break lower. I explained how I'd like to see the one specific swing low to be taken out. And I wouldn't look at the relative equal lows as a shift in market structure because it's potentially both directions. Now, that SMT divergence could have been erased quickly. Dow could have snapped up there, changed everything. Because the market was consolidating back and forth, instead of just making one pass higher, failing, and one single pass higher, and then breaking down. That's a clean market. That's price direction that's easy to spot and predict. But when it has multiple high, low, higher, low, higher, lower, low, higher, high, you're in a condition that could easily become seek and destroy. And seek and destroy many times starts off where it feels like you know what you're looking for or what it's likely to deliver to you. And it takes it from you. It's like a carrot that's just dangled in front of you, like, here's the easy money, come get it. Just all you gotta do is push the button. And as soon as you get in there, you regret it because it runs the other direction immediately. And that's what this morning was doing to a lot of traders. And my goal is for you to anticipate these types of movements in price so that way you don't fall victim to getting in there and trying to impose your own will or block out the two-sided or dual nature of price delivery that is available in those conditions, meaning it's easy for someone to use my concepts and justify both directions. And if that's the case, that is low probability. That means you cannot frame a low resistance liquidity run where it just runs quickly and the price action is really clean. If you go back and look at your charts, and this is what you should be doing when we're done talking this evening, you want to be looking at it and taking note of how many times each individual 1 minute candle overlapped the previous. Back and forth, back and forth, back and forth. That is a market that is struggling to trade outside of a holding pattern. All it's doing is moving just a little bit, coming right back in, moving a little bit, coming back in. And it might eventually drift to an objective that might be visible to you. We outlined it this morning, but it doesn't feel like it wants to get there in a hurry. That's another classic signature of a low resistance liquidity run. A low resistance liquidity run is what you're trying to get good at spotting, anticipating, expecting, and engaging. High resistance liquidity runs is what you're trying to observe and learn how to spot so you don't have to go in there and trade them. So you have to know what both of them are. You have to know what one is so you can hopefully avoid it, or at least at the very minimum, know not to overtrade, not to do 5 trades, 6 trades, 12 trades, break every rule because you're in drawdown. By looking at only the high probability conditions where the market is offering you a low resistance liquidity run, those moves are very forgiving. Whereas these days, like we had this morning, they're not all that forgiving. Meaning when you're wrong, it's very difficult to get yourself out of the hole that you dug yourself into. And for some of you that were pushing the button when you knew you shouldn't have done it, you saw how hard that was. Learn from that. It's okay. There's no shame in it while you're learning, but it is shame when you don't learn from this and you start doing it all over again. When you know that the conditions are indicating to you that we are in high resistance liquidity. And you're probably hearing me say that so much. You're like, when is it ever going to be low resistance liquidity runs? I know, but we're in a climate right now that is very, very hard to work with. So you have to be very diligent about what it is you're looking for. You have to be very patient, and you have to be, well, shrewd. Demand a lot in terms of what the market's offering you for a setup. Whereas when we are in low resistance liquidity run, I mean, I could just simply go in here and say, okay, well, here's where the liquidity is going to draw to, above or below the marketplace. So we already have our bias, we have our direction. That's easy. Then go in there and just pick any opposing PD array. If we're bearish, we're looking for anything to get short on. Institutional order flow, bearish order block. You think about the examples I show you. All the recorded trades, they are low resistance liquidity runs. Look how many times I'm entering on a pyramid entry and how many opportunities there are with that. How many opportunities did you see getting in today to get down to that sell side? Not many. And it was very clustered. Like it was a mess. It was like a 5-year-old took a crayon for the first time and tried to color you a picture. It was scribbled up and down, up and down, up and down, back and forth, and still ultimately getting down to where we were looking for. But the drive there, the travel, getting to that destination was very long, very, very uncomfortable. And that's the difference between a high resistance liquidity run versus the trades that you see me recording where it just runs really nice. So I guess in a lot of ways, when those individuals that don't like me or want to smear me or whatever, they'll say, oh, he's cherry picking. I am cherry picking, absolutely cherry picking. They're going to take this soundbite completely out of context, but I'm cherry picking the low resistance liquidity runs. Just like I'm cherry picking those when I'm tweeting. I'm telling you where they are. So that way you can study them. But it would be unfortunate if I was trying to mentor you and only giving you the candy only, just like books and courses and things. Everybody has a way to get in. Everybody has a setup that they think works. But nobody knows how to navigate the treacherous waters, those storms out at sea where you just don't have dry land to take shelter on. You just got to ride it out. Sometimes we'll be able to see these storms coming in and we'll batten down the hatches and dial back our frequency, dial back our risk, or simply say we're not going to do anything today because it's high resistance liquidity. It means it's going to move around, yes, but it's going to move around in a manner that we aren't really interested in. So you just observe it, tape read it, paper trade it, whatever. But the moves that we're really hunting, that pick up all the slack, that pay for all the times when you're really not trying to engage more than is necessary, that's the low resistance liquidity runs. They're the ones that run 20, 30 handles real quick, multiple entries, all giving opportunity to get on board, even though they're moving quicker, cleaner. They offer multiple entry points until we get to that that threshold of, if you're bearish, once it gets down into the discount area, then we can't take any more entries because the likelihood of it offering it is going to be very slim. But when you're bearish and we're in the equilibrium or above portion of that price run that we're anticipating, every potential PD array is up for grabs for a short. And that's what I'm showing you when I'm doing those examples where I'm recording multiple entries, building up a larger position, 6 contracts, 3 contracts, 1 contract, or 6, 5, 4, 3, 2, 1. I'm really trying to build it up. Today was not a day that I would have been able to go in and do a pyramid entry on any of that. Now, when you hear that, it's like, well, that sounds like kryptonite to ICT. Well, it is. I told you I'm not interested in trading those. I know where my weaknesses are. I know my weakness in my concepts. I know my weakness in my ability as a trader. I know where I will fall victim to emotion. I'm obsessively compulsive. That means if I do trade in those instances, I will regret it if I do it wrong, which means I'm going to be more prone to do what? Lean on my skill, my ego, to try to fix it and try to be finessing some kind of correction in it. And it may not deliver like I want it to. So I'm trying to communicate it to you that this is where I have failed. That part of trading, teaching, this is the part that you really want to pay special attention to, because this is where you're going to fail. And if you're new, you don't know that you're going to fail here. You don't know that this is going to repeat in the future, and you won't see it coming. And when it knocks you down, it may be so bad of a knockdown that you may not be able to come back from it. It may be too much for your psyche to endure. Think about this morning. That was very exhausting, wasn't it? Sitting there together for about 2 hours or so and seeing it do pretty much nothing, just banging around inside of a very small range. Do you want to spend your trading day when there's nobody telling you that this is not a good thing to do? It's better for you to just close your trade, close your charts, and go do something else. Do you want to be in that environment with next to no experience with a live account in drawdown? Think about that. That's what I want you to be thinking about today. Some of you did it. Some of you did it to yourself, not listening. And now you know what it feels like. And you gained scar tissue. And it sucks because you didn't listen. And every time you don't listen and you do something you shouldn't do, you're gaining more scar tissue. And that makes it harder and longer for you to learn this, when you could just simply just do what I'm telling you to do. No risk. Just observe. No demo trading either. Did you hear me say, take a demo here, take a demo? Nothing. Lower your expectations. Why? I'm preparing your mind to anticipate that very condition. And we saw it back and forth, back and forth. You won't likely blow your account on days that are just absolutely one-sided.